So, hello and good afternoon. I welcome everyone to today's weekly market outlook here for Admiral Markets. We want to have a look at the developments from yesterday with the ECB rate decision, which resulted in some volatility, in fact. So when looking at the price action, especially in the DAX, for example, but also the bullishness in euro, some might come to the conclusion that the market obviously expected a more dovish stance from the ECB. But this is only one topic for today. So we also want to surely have a look at the non-farm payrolls, and they will be published today. I have something from Bloomberg prepared. So we want to have a clear look at what the market is currently expecting. It's surprising, to be honest, and it perfectly illustrates that there's probably some downside potential for the US dollar if the data set disappoints. But before we start, we have to surely have a look here at the risk disclaimer, as usual. Go through some slides before and then start with today's agenda, and also have surely a market outlook then for the upcoming week, the events which will be of interest, and what to make out of this. So the risk disclaimer: trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. For further information, that were only the first two sentences of the risk disclaimer. For the whole risk disclaimer, please reach out to the website admiralmarkets.com to read the full version. We want to have a little deeper look here into the differentiation between retail clients and professional clients, as usual, after the ESMA decision in August 2018. So there's now a leverage cap here for retail clients, maximum leverage of 1 to 30 on Forex majors, something like EURUSD, for example, or USDJPY, 1 to 20 on other currency pairs, so-called minors. Here we have, for example, just to give one, GBP Australian dollar, for example. 1 to 20 is also the leverage cap on CFDs, like the German DAX 30, and also gold, for example. And the differentiation now comes into play between retail clients and professional clients. So professional clients are still allowed to trade with a leverage of up to 1 to 500. And now the question might probably be, what can you do to be reclassified here as a professional trader? They have certain criteria to be met here. For further information, please reach out to Admiral Markets, which criteria will be met, and find out whether you can then apply for a professional client standard, if this or a status, if this is something of interest for you, due to, let's say, for example, you have a strategy which needs high leverage, for example, because of lower margin requirements in this case. What's the big differentiation now between retail clients and professional clients is there's the negative balance protection, which is unlimited in case of retail clients under ESMA, while, and this is special about Admiral Markets, as a professional client usually do not have such a negative balance protection, but in case of Admiral, you have a negative balance protection of up to £50,000 according to the policy from Admiral. So also here, for further information, feel free to reach out to Admiral. That's me, the face to the voice you're currently listening to. And here, probably one detail from my end. So I'm located in Berlin, Germany, and Admiral Markets, we want to have a look at the slide here in a few seconds. Admiral Markets has offices around the world, and in fact also one here in Berlin in Germany. And here in Germany, this is something which perfectly answers already the question why Admiral Markets, why to choose Admiral Markets as a broker. It's the case that here Admiral has a very, very competitive DAX 30 offering. And in Germany, we usually refer to Admiral Markets as the DAX expert. As far as I know, that's also written on the website. Admiral is also a licensed partner. So there is a copyright to the name DAX 30. And so this is already illustrating that there's obviously a very competitive offering in place with a typical spread of 0.0 during main trading hours. Admiral Prime offers a spread of 0.2, in fact, with commission on top. This is especially interesting for short-term DAX traders in this case. Then there's also surely a very competitive FX offering. Again, feel free to reach out to the website. It's definitely worth it. And yeah, One World Global Office, I already mentioned it. Offices around the globe, different regulators looking over the business from Admiral Markets, and that's not only the FCA in the UK, but also, for example, here there's some in Australia, Admiral Markets Pty Limited with an Australian financial services license, for example. What this could mean from a regulatory perspective also. Reach out to Admiral, to the website, and have a look. Here are the contact details. And yeah, that's it around the introduction. Now let's have a look at our agenda. I already mentioned we want to have a deeper look at the ECB from yesterday. We want to have a look at the NFPs, but also surely at the upcoming week of trading and then the news events which might be of interest and potentially driving markets. So what are the key economic events in the coming week of trading? Then also we want to answer the question, what's the current bias in FX, equity and commodity markets? This is yeah, definitely of interest, especially when looking at the current developments here at the Fed Watch tool. Here, in fact, I can already say that market participants are already pricing in 3 rate cuts with a likelihood of over 50% by the end of this year, which is really huge when looking at the fact that around 6 to 9 months ago, we had 3 rate hikes for 2019 expected from the market. And still the US dollar seems to be quite stable when looking at the US dollar index future, for example. And here, surely the non-farm payrolls come into play and potential disappointing readings, which could then trigger some weakness of the US dollar into the weekly close. And surely we want to answer the question, which trading opportunities may arise out of all this. And now let's have a look here then at the charts and at the current picture. So first of all, we want to start here with EURUSD. You can already see there the candle from yesterday. We pushed to the region around 113. Currently, we have some trouble to gain further momentum. Potential reason for that is a data set which came from Germany, which is pointed out here. Let me just probably bring this up. Tradingeconomics.com is my source for all fundamental developments, and there you can see it. German industrial output falls the most in 4 years. Potential sign of a recession forming at the horizon here in Germany too, not only in the US when looking there at the inversion of the yield curve, 2 and 10 year yields, for example, but also in Germany. And that's probably also then one reason why we have this rhetoric from the ECB yesterday. So there was no surprise in regards to the rates. So no cut, no hike. But what they mentioned here, they added to the statement. Before there was the mentioning that the ECB plans to keep rates at this current level here till the end of 2019, and they changed this now to the wording that they plan to keep rates at this level at least through the first half of 2020. And this is already a clear sign that there's, from a yield perspective, not much to be expected. We also should remember we had into 2018, end of 2018, we had the expectations that the ECB probably will hike rates in the second half of 2019. Also, this completely changed. So main potential driver, surely it's not only that we are here and from a cyclical perspective now entering potentially the final stage of this business cycle in regards to an upswing, economic upswing, let's call it, but that we are about to end this and potentially drift into a recession, which is completely normal, and it's nevertheless potentially accelerated, and it's the main reason for this aggressive turn in rhetoric from yeah, we can say kind of hawkish to ultra dovish can surely be found in the still brewing and potential escalating trade war between the US and China especially. So, and nevertheless, that was not the most interesting thing here, in fact. But what was of higher interest was potentially the details on the TLTROs, the so-called targeted long-term refinancing operations, and the liquidity provided by the ECB from September onwards for the European banking sector. Which initially sounds promising, delivering cheap liquidity to banks is definitely something to be very skeptical about, because it's the third round of TLTROs, which is now given to the banking sector. And I can tell you the first two didn't work out well, if looking at the economic developments in the Eurozone. So it's to be expected that this round of TLTROs will not get the job done in terms of spurring inflation or something. It's very likely that this TLTRO program fails too. Nevertheless, it's surely of interest and to look at the details of this TLTRO program here for short-term action. And when looking at the DAX with the drop lower, when looking at EURUSD with a push higher up to 113, you can obviously see that the details which were delivered here were obviously considered from a market perspective here hawkish, which is funny when looking at the details. So the lines in the ECB statement read as follows. So it will be set at a level, so the TLTRO yield level, it will be set at a level that is 10 basis points above the average rate applied in the Euro system main refinancing operation over the life of the respective TLTRO. That sounds somehow a little complicated. To give you a clear number, 10 basis point above the current main refinancing operation. This number is currently set at 0%. So 0.1% on top of that means that the TLTROs are usually priced, or yields are set at 0.1%. But, and this is the interesting thing now, there is a special mentioning for those banks whose eligible net lending exceeds the benchmark. So there, the rate applied in TLTROs will be lower and can be as low as the average interest rate on the deposit facility, prevailing over the life of the operations plus 0.1% or 10 basis points. So what's mentioned here is the lower yield band, in fact, and this is currently set at, as we all know, 0.4, minus 0.4%. Minus 0.4% plus 0.1 means the yield of these TLTROs can be as low as minus 0.3%. This is already very dovish, yes. Nevertheless, it was expected, especially when looking at the overall details, obviously, that markets were expecting something in the region around minus 0.1, minus 0.2, which could have get the job done in kind of weakening the euro, respectively pushing the DAX higher. That wasn't delivered, and that's potentially the reason why the euro then rose, in fact, and has further upside potential, in my opinion. Because we have to here then consider the fact that the Fed should be expected to rather sooner or later cut rates and not sound very, very hawkish. And all in all, the overall picture from a rate perspective in the Eurozone didn't necessarily change dramatically, even though what surely has to be mentioned. Therefore, I've prepared here my Twitter feed to have everything here in this feed and not need to click on different tabs here. Yesterday, for example, 10-year bond yields in the Bund future dropped to minus 0.323%. That was nearly in the region of the current all-time lows. It should be expected that this continues, this drift lower, even though when looking at the yields in the US Treasuries, T-notes here in this case, then we can say that overall there's some further room on the downside, which could result in the yield differential between European or especially German bonds and T-note futures, US T-note futures, then to narrow, which would then indicate further gains, potential further gains in the euro, especially given the fact that in the commitment of traders report, we can clearly see that currently the large speculators are aggressively net short the euro. When looking at the current developments here, then from a chart perspective, you can see there's a drift lower, but it's not that we have a strong trend here on the downside. That's definitely not the case. And so my thinking here is, in fact, that currently those large speculators are most likely holding this position net short in the euro from a carry trade perspective. And that means nothing more than once this yield differential is now narrowing, respectively, the euro is about to reconquer probably 113, that then here the expected value of this trade, of this carry trade, being euro short and being long the US dollar, could turn negative, which means market participants are then likely to cover these short positions and potentially driving euro higher and potentially resulting in a short squeeze. So what does it mean in the short term? It means nothing more than I see a good chance that here the euro will probably and likely break above 113 in the meantime. So the next days, it's definitely a chance. Potential driver, sure, here economic calendar next week. The overall economic docket is quite thin, while on Wednesday we have core inflation data here, and then also retail sales and consumer confidence data from the University of Michigan next week, which is all not so spectacular, let's say. But in fact, probably we get to see such a break higher already in around 1 hour from now when the non-farm payrolls will be published. And therefore, let me now show you what I've prepared here. This is potentially very interesting. It looks at first glance looks a little difficult to understand, even though it's very insightful. It gives a very great idea of where we currently stand. So probably we shouldn't start with this one, but probably have a look back on Wednesday and what happened there. On Wednesday, ADP data were published. It came in significantly below expectation. That was here, with only 27,000, while the consensus was 180,000. So obviously big disappointment. And this is interesting because what you can see here now in this chart, what trading economics delivers is you can go back, as in this case, more than 5 years, and then you can overlay the ADP data set and numbers which were published in blue. Here you can overlay this with the non-farm payrolls. And what you can see is that all in all, these numbers seem to correlate quite well with each other. This is especially true when looking here now at the fact that this blue line dropped significantly lower. And as you can see, by the way, if you go down low as 10 years, you can see that this data set, last time that we've seen such a disappointment ADP data, you have to go back nearly 10 years. And so with this in mind, I would say chances are quite high that the NFPs today will disappoint too. So why is that noteworthy? Well, it's noteworthy because when looking here at the median estimate here, you have 180,000, average estimate 172.96 thousand. This is, in fact, what is it? It's in fact only an idea, or it's an average number. It's an average number from all economists which were asked from Bloomberg. What's interesting here in this chart is the following: that any of these columns is showing market participants here expecting the numbers to come in at a certain level or within a certain range. And then what you do is, in fact, you put a line on this, or you get such a normal distribution about this. And while this is at first glance only a pure mathematical approach, and some might say, okay, what does this deliver for our trading? Well, what's important when looking at data releases, especially such important data releases where everyone's looking at, in this case, the non-farm payrolls, you have to, or what's really or important to know is, what does the market expect? So where is disappointment happening, or where's a surprise happening on the upside? Surprise on the upside or on the downside? And what's interesting in this case is that when looking here at these columns, you can see that there's around 190 to 200,000. There's the most analysts being ranged here in this region. So that means, in my opinion, nothing more than that the most market participants seem to be positioned on a quite solid NFP reading, which is not that likely after the IDP data set, which means if the data set now comes in below expectation, and when looking at 180,000, then we could say everything, in fact, below 160 is definitely a disappointment, in my opinion. If this is really coming in as low as the EDP, probably, this would be a big disappointment, catch markets on the wrong side, especially US dollar bulls, and could then trigger the push higher, in this case, in the Euro USD above 113. And going hand in hand with the, let's put this in quotation marks, but when looking at the expectation from market participants into yesterday's ECB decision, we can look at the ECB decision and the final decision and the final communication, rhetoric statement from the ECB. We can definitely consider it to be kind of hawkish, in fact. That this combination is then definitely good for a push above 113. On the other hand, sure, we have to consider the fact what happens if data comes in better than expected. Therefore, in my opinion, I think it's definitely important. It's definitely important to get a reading significantly above 200,000, which is not that likely, in fact. Still, we have seen some surprises in the past, and why not this time too? If such a reading happens, then it's the other way around. It's a very interesting development here too. This could short-term result in a push higher in the US dollar, especially in yields-sensitive currency pairs. Not sure about the euro in this case, to be honest. I'm not really sure whether this would then result here in a sharper drop in the euro. Probably only at an, let's say, stabilization here at the region at 113. And there was also a mentioning, not sure whether this is true or not, but I read that there's currently a potential option and a big expiration at 3 p.m. London time. So in fact 10 a.m. Eastern time, so New York time. There's currently potentially such a big expiration holding the euro back from recapturing 113 in this case. Probably then we initially see a stabilization at the current level, and after 3 p.m. London, we finally get the break to see higher, even if the data comes in better than expected. That's definitely something to keep in mind. Nevertheless, my main currency pair, in fact, when looking at FX, is around the NFPs, surely the dollar JPY, and there you can already see here what I'm currently looking for. So I'm in fact hoping for a pullback. And by the way, I'm sorry, this is not the right number. It needs to be 109, 109.20. 1 second, please. Yeah, it's 109. It's not 870. So such a pullback would be definitely of interest here with the overall outlook and the dovish expectation around the Fed. As long as we trade below 110.17 dollar JPY, further losses seem very likely, and 109 being a potential short trigger. What's also very interesting in this regard is the following, and therefore let's just switch to my Twitter feed once again and probably scroll a little lower. That was already yesterday in the morning. I published it. Yesterday was Thursday, right? Here. There was an interesting tweet with putting the G20 in Osaka at the end of the month into the focus here. There was no rumors. It's unnamed sources. No one really knows if it's true or not, but I could imagine it to be true, let's say. It was said from some unnamed source from the US Treasury that the US Treasury Secretary Mnuchin will potentially discuss a currency clause with the Japanese finance minister, Aso, here on G20 at the end of this month. And why is this noteworthy? Well, I think that this, even though we do not know how such a clause, if it will be discussed at all, that's also something worth mentioning. But what it perfectly illustrates, in my opinion, is that there's obviously a strong willingness from the US to weaken, especially the Trump administration, to weaken the US dollar. And with this in mind, I have to say that I could imagine here really further losses to happen in the next days, weeks, probably months to come, and that we have a serious chance to trigger short against 109 and then go for rather sooner or later test of these flash crash lows from January around 104.70, 105 here. And this is true on the daily chart as long as we trade below 110.70. Also important is surely when looking at yields, we have to look here at gold in this case. So some of you might have followed the technical analysis section, respectively the traders block section, and the weekly outlook here on the website from Admiral Markets over the last days. So you can find it, by the way, admiralmarkets.com, and then here via analytics, technical analysis in this case, or here traders block. This is where the weekly outlook is always published, and there you can see there's also some links in it and to the other articles. For example, last Monday we pointed out that the push above 1,310 is likely to accelerate over the next days, which in fact happened. And I mentioned here during this, or within this research piece, I mentioned 1,325 US dollar on the upside as a first target, only a stopover, and from there likely we are likely to make it higher up to the current yearly highs. We already pushed to this region here on Monday, and yeah, continue to gain momentum over the last days, especially with with the ADP data set and with expectations from market participants that the Fed will come out very, very dovish over the next months, in fact. So by the way, let me just illustrate this here with the Fed Watch tool, also very interesting. You can see here the tool, for everyone it's available. Fed Watch tool, just Google it, and then the CME gives an idea of what market participants are here expecting for the rates to be in the near future at each event of the Fed. In this case, of the last event in 2019, December 11th. And what you can see here, this is the current rate level, and now there's obviously minimum one rate cut. In fact, if you add up these numbers, you can see that the probability is minimum 97% for one rate cut. In fact, when you add up those numbers, you can see here that the market is now expecting the Fed to cut rates by nearly 50% here. So 32.4 plus 13.9. This is already adding up to 46, and then here, so it's nearly 50% of market participants who expect the Fed to cut rates minimum 3 times in 2019. And this is also a very dovish outlook, which is then good, in my opinion, for a drop of 10-year US Treasury yields to push them below 2%, and this usually goes hand in hand with potential further gains here in gold and on the upside. And in this case, it means that there's a very good chance in this case that we'll make it rather sooner or later above 1,347 and then we go for a very crucial region around 1,360, 1,370 USD, which is a strong line of resistance. When you look here at the weekly chart, and let me just see whether I'm now capable of getting the information here together, because obviously it takes some time waiting for an update. It's not very good. Okay, yeah, just believe me. Just believe me. I prepared next time. So in fact, it's the case that here this is a very strong line of resistance. It's the 2016, it's the 2017 highs around this region, and here it's it's also the region around the 2018 highs, which means that we have here a very strong line of resistance, which has overall, resulting out of a rising wedge here, which has potential projected target on the upside around 1,700, 1,800 points. So also from a long-term perspective, gold seems to be very, very attractive from a long side here on the upside, and should carefully watched. In fact, once we, if at all, surely, but nevertheless, once we break above 1,300, 365 USD here on the upside. This is in fact a very crucial region, resistance zone here on the upside, and will be of interest once we reach this region here. Then in regards to today's NFPs, you can also see to some extent, when being so bullish for gold, I have to say that I really appreciate such a push here on the downside and retest of 1,325, 1,310 US dollar as a potential long trigger. And this trigger could definitely be found if non-farm payrolls surprise on the upside, but they have to significantly surprise on the upside, as already mentioned several minutes ago. So a reading significantly above 1,000 and then I'm sorry, 200,000 is, in my opinion, necessary to trigger such a corrective move. And even it's not said after the developments of over the last days that we get to see a retest of this trigger, then today probably it will take some time over the next days then that we retest this region. Still, it's definitely, in my opinion, worth to keep a close eye here on this region, and then probably we take off from there, go for an attack at the region here at 1,347 USD, and then also potentially further gains again up to 1,360, 370 are likely, and also a push higher could trigger some serious bullish momentum then on the upside. So, and then let's have a look here at the DAX. We already mentioned the bearish reaction, I think we can definitely call it here, yesterday. So this is now, I'm sorry, that doesn't make sense. In fact, let's just switch to the hourly chart here. Why not? So what can we see is that here, after the push higher yesterday, we failed to make it above 12,120. That means that all in all, the overall mode stays bearish on an hourly chart, short term, and we are now going for another attempt to break higher, even though it also depends to some extent, in my opinion, whether non-farm pairs come in better than expected. So I think the time is over for where the time is not given anymore, where bad data was good data, let's say. So in the past, it has been the case that bad data usually resulted in speculations around market participants, where I said, okay, great, if data comes in bad, it means more stimulus from central banks, lower rates, more QE, whatever. Then we had, based on that, potential bullishness in equity markets. I think this time is not necessarily given anymore. Sure, this takes time to develop such a bias in markets, but nevertheless, I could imagine that any bad data set now is, especially after all these rounds of QE and all this quantitative easing and low rates, is definitely something to worry about, because it shows that then if there's more liquidity provided by central banks, it probably goes not necessarily hand in hand with economic growth or a potential positive outlook for the near future here, but it's an economic downturn, it's potential recession, and we have more liquidity then provided in such an environment, which is, in my opinion, not necessarily bullish, but in fact it could probably reduce the downside potential, but still it wouldn't come as a surprise if the market keeps on moving lower then, and that's potentially accelerates on the downside. So that's why I say that today non-farm payrolls have to come in better than expected to trigger bullish stint on the upside and leave us or give us a chance to push back above 12,100 points. If data comes in lower than expected or disappoints, then I have to say that I consider the region around 11,900 points to be of interest, definitely, I think, because once we approach this region and a drop below this region, further losses are very, very likely to happen here. In this case, it could trigger further weakness, minimum as low as 11,800 points. That does not necessarily mean that we get to see this today, but still in the days to come. And also in the next week, another attempt to attack 11,600 points is on the table, especially, and this is also something which should be remembered all the time, when looking at the current market developments, especially with the fact that so far there has been no countermeasures from the Chinese in regards to the attacks from the US on Huawei here. So there has been no attack from the Chinese on Apple or on any software companies in the US being dependent on the Chinese delivering whatever goods to them. And so yeah, with this in mind, there's all the time this sword of Damocles somehow above the market and this shadow, and any new escalation could definitely result in another push lower, and another attempt to break back below the SMA 200 in this case. So this is the blue line. You somehow, or I think you when you followed the webinar here, you have seen that this was a region I pointed out, 11,620 points as a retest of this region. If we drop below 11,800 points, is a very serious option. We tested this region already on Monday and bounced back from there, back towards 12,000. And now the question is, will there be another attempt to break lower? If we take on serious momentum, then I think there's a serious chance for a push lower. And if such a break occurs, further losses are likely to happen here as low as 11,200, 250 points. Still, I want to probably have a final look here at the S&P. Which saw this break below this potential neckline. Some of you remembered this potential hedge, not head shoulder, double top formation here. We made a topic, and where we projected a target as low as around 2,670, 2,700 points on the downside. And now we reconquered this line again. Still, as long as we do not make it back here above 2,890 to 2,900 points, there's definitely fears that we also see here another leg lower. And once we push below 2,740 points, there's also further losses in the S&P to be expected, which will definitely weigh heavier on the DAX and result in a potential, at least serious attack at 11,600, 620 points.
even where it probably will not only be an attack, but probably a very serious attempt to break lower than. So with this said, any pullback here and any signs of exhaustion in this current move in the S&P in this case below 2,850 points is probably good for looking for short engagements. The same is true here for the DAX. If one plans to anticipate such a break on the downside and position himself or herself in a short engagement, aiming for another attempt to attack 11,600 points, then potentially the line in the sand can be found around 11,900, 11,920 points. If we drop below that, that could be the short trigger, which could then accelerate a further move on the downside as low as 11,600, 620 points. So, and yeah, that's it from my end. So then I wish you happy trading. Good luck with the non-farm payrolls. Be aware, in 45 minutes at 1:30 p.m. London, the non-farm payrolls will be published. I hope that I was capable of giving you a good idea of what to expect here, and let's just see how it turns out. At least it definitely makes sense in the current environment to formulate a clear tableau here, a table. What to expect, and if the others come in a certain direction, what to expect, and if this expectation is fulfilled, or if it's probably negated, which could then trigger probably even more aggressive move in the other direction. Yeah, and so that's from me. That's it from my end. So I wish you a nice weekend. Happy trading, watch your stops, enjoy yourself over the weekend. Talk to you again then next week on Friday again. I definitely look forward to it. And if you have any questions, feel free to send them over. The recording of this webinar will be available in a few minutes to, oh no, I'm sorry, no, it will be published tomorrow over the weekend. So if you're interested to watch this again, you have to wait till tomorrow, and then you can find it in the webinar section, no, the YouTube channel from Admiral Markets. And yeah, so that's it from mine. All the best, greetings from Berlin, and have a nice weekend. Enjoy yourself. Talk to you soon. See you, and bye-bye.